Right before we started recording today, I was standing in the kitchen, going through my daily ritual of making a pour-over coffee.
Oh, yeah. The sacred morning routine.
Right, exactly. And if you're a coffee nerd like I am, it is essentially this deterministic physics experiment.
You got the whole setup, the scale, the timer.
Yeah. I dial in the exact water temperature, usually around 205 degrees. I measure the precise grind size of the beans. I pour the water at this very specific flow rate.
And because the laws of thermodynamics are constant, you get the exact same cup every time.
Exactly. It's stable. It is incredibly grounding. And I realized this morning that I actually crave that little 5-minute window of predictability precisely because the moment I sit down at my desk, I am looking at a system that is the exact opposite.
Utter total chaos.
Complete chaos. We are looking at a financial and digital landscape right now that feels, well, wildly chaotic, highly reactive, and frankly unprecedented. So welcome to Inside Bitcoin.
It really is that contrast, right, between the physical predictability we crave and the absolute structural chaos of the markets right now.
Yeah, the whiplash is real.
It is. And for you listening, the mission of this deep dive is to basically guide you through that exact contrast.
Right.
We are going to start by looking at the intense macroeconomic pressures, the geopolitical shockwaves, and the regulatory battles happening in the physical world this week.
Which is a lot to cover on its own.
Absolutely.
Yeah.
But we aren't stopping there. The real goal today is to understand this monumental structural shift happening right beneath the surface of all that noise.
Yeah, the stuff people aren't paying attention to.
Exactly. We are moving into a framework where Bitcoin data is literally being transformed into actual ownable digital real estate.
Right.
It's this massive transition from, arbitrary virtual tokens to a permanent physics-based digital reality.
And it is fascinating how the loud, chaotic market volatility on the surface is acting almost like a smokescreen for that build-out.
A total distraction.
Right. So let's start with that surface layer, because the physical world pressures are actively squeezing the market as we speak.
Yeah, let's look at the numbers.
So we are looking at the data for this week, ending April 24th, 2026. Bitcoin's rally has essentially hit a brick wall.
Right below that $77,500 mark.
Exactly. And the volatility is cooling off, but not in a healthy consolidation kind of way. Traders are rapidly unwinding leverage.
They're stepping back.
Yeah, and what is really catching my eye is the US dollar. Bitcoin and the DXY, the dollar index, are moving in near perfect opposition right now.
The inverse correlation.
Yes, we are seeing an extreme inverse correlation that we haven't witnessed in almost 4 years.
And the mechanics of that inverse correlation are crucial to understand. When the dollar strengthens, global liquidity basically tightens.
Capital gets way more expensive.
Right, and that disproportionately affects hard-capped, non-yielding assets like Bitcoin.
Because it doesn't pay a dividend.
Exactly. And we are seeing the direct result of that tightening in the institutional flows. Over the past 8 days, we have seen a massive wave of distribution.
Just a total bleed.
Yeah, Bitcoin ETFs have bled out roughly $2 billion.
$2 billion. That is not small retail traders getting spooked.
No, not at all. That isn't just retail panic. That is algorithmic de-risking by major institutions.
Right.
And when you look at the on-chain data, the short-term holders, so the entities that bought within the last 3 to 6 months, they are quietly but steadily selling off their positions.
Just trying to break even, probably.
Yeah, break even or take whatever tiny profits they have left before things get worse.
Which begs the question, what is driving that institutional de-risking? Why the sudden flight to the safety of the dollar?
The macro picture is getting very tense.
It is. It brings us right to the geopolitical macro jitters. The headwinds are severe right now.
Oh, yeah. Look at Japan.
Right. You have inflation actively ticking back up in Japan, which threatens the last real pocket of cheap global liquidity.
The yen carry trade unwinding is always a looming threat.
Exactly. But the massive, unavoidable catalyst dominating the tape right now is the Middle East.
The Strait of Hormuz situation.
Yeah. Iran has officially begun collecting revenue from tolls imposed on commercial ships transiting the Strait of Hormuz.
Which is just a massive choke point for global energy supplies.
It's critical. And in response to that escalating situation, the Pentagon has just put forward a staggering $200 billion supplemental budget request for the ongoing Iran war.
Let's just pause and contextualize that $200 billion figure for a second.
It's hard to even wrap your head around.
It really is, because human brains aren't naturally equipped to process numbers that large.
No, we just hear billion and it all sounds the same.
Right. So if we translate that fiat request into the asset we are analyzing today, $200 billion equates to nearly 2.9 million Bitcoin at current prices.
Wow. 2.9 million Bitcoin.
Yes. Just to put the sheer gravity of that into perspective,
Yeah.
that is roughly 8.6 times the size of the entire United States government's strategic Bitcoin reserve.
That is wild.
It represents almost 3 times the amount of all the remaining unmined Bitcoin supply that will ever exist.
Just printed out of thin air to fund a conflict.
Exactly. The scale of the fiat printing required to fund that kind of physical conflict is exactly what causes the market to short circuit.
And I actually want to jump in here and explicitly state for you listening, we take absolutely no political sides regarding these geopolitical events or the defense budgets or the conflicts themselves.
Not at all.
Our role here is strictly analytical. We are looking purely at the fiscal data, the expansion of the money supply required to fund these initiatives, and the psychological impact that has on global markets.
Yeah, we are observing the mechanics, not taking a stance on the policy.
Exactly, just looking at the data.
And those mechanics are generating undeniable psychological trauma in the markets right now.
The fear is palpable.
It is. We track sentiment using various metrics, and the market's extreme fear index is currently sitting at a 10 out of 100.
A 10. That is rock bottom.
And it has been pinned there for over a month and a half.
Wow.
That level of sustained, visceral fear matches the terror we saw during previous historic market collapses. Retail investors are just paralyzed.
They're caught in the headlights.
Yeah, they are watching inflation, they are watching global conflict, and they are literally freezing.
But here is where the narrative splits and where the data gets incredibly contradictory.
This is the interesting part.
Right. You have retail sitting at a 10 out of 100 on the fear index and ETFs bleeding $2 billion.
Panic selling.
Yeah. But on the other side of the spectrum, the corporate and regulatory environments are aggressively building.
They're quietly buying up the floor.
Exactly. Look at the corporate accumulation, Metaplanet, which is this prominent corporate entity that has essentially adopted the MicroStrategy playbook.
Holding Bitcoin on their balance sheet.
Right. They just successfully raised an additional $50 million specifically to purchase more Bitcoin.
Right into the teeth of the fear.
Yeah. They aren't paralyzed by the $77,500 stall. They are treating it as a prime acquisition window.
Because they were looking past the current quarter.
Exactly.
Corporate treasuries understand that when macroeconomic instability spikes, the long-term play is acquiring pristine collateral.
You want hard assets when the fiat printer turns on.
Exactly. And that corporate confidence is being bolstered by a massive shift in the regulatory landscape.
Though it's a bit of a mixed bag right now, depending on where you look.
True. While the state level is seeing tremendous friction, like, for instance, Wisconsin just launched aggressive lawsuits against major crypto and trading platforms.
Oh, right. Kalshi, Coinbase, Polymarket, Robinhood.
Right. They are primarily fighting over jurisdiction and the operation of prediction markets. But while that's happening locally, the federal level is actually providing unprecedented clarity.
Yeah, the Wisconsin situation is fascinating because it really highlights the friction between legacy state regulations and these borderless digital systems.
It's a total clash of paradigms.
Right. Prediction markets like Polymarket and Kalshi allow users to essentially trade on the outcome of future events using crypto rails.
Which is a highly efficient way to aggregate data.
It is. But state regulators often view this strictly through the lens of unregulated gambling, while the platforms argue they are providing highly accurate data markets.
It's a classic turf war.
Exactly. But you're right. The federal level is a completely different story. We just saw the SEC and the CFTC issue a joint 68-page interpretation.
A massive document.
Huge. And it formally classifies major assets, specifically Bitcoin, Ethereum, Solana, and XRP, as digital commodities rather than securities.
That 68-page document is a watershed moment for the industry.
It really changes everything.
It does. For years, the industry has been operating under the threat of regulation by enforcement.
Just random lawsuits out of nowhere.
Exactly. The classification of those specific assets as digital commodities clarifies the rules around staking, the tax implications of mining, and the legality of network airdrops.
It gives them a safe harbor.
Right. It effectively removes the existential threat that a federal agency could suddenly deem the entire underlying infrastructure of these networks illegal.
Which was always the dark cloud hanging over the market.
Exactly. Furthermore, you have SEC Chairman Paul Atkins publicly asserting that a solid, comprehensive regulatory foundation will be formally in place by the end of 2026.
And the traditional finance plumbing is actively connecting to this new foundation as we speak.
They're laying down the pipes.
Yeah. Morgan Stanley didn't just announce a Bitcoin spot ETF. They are actively positioning themselves to become the premier reserve manager for the entire stablecoin industry.
Which is a massive power play.
Think about that. The global stablecoin market is approaching historic highs, basically acting as the digital eurodollar system for the world.
And Morgan Stanley wants a piece of that infrastructure.
They want to manage the underlying U.S. Treasury bills backing those stablecoins. It's huge.
The yields on that are astronomical.
Right. Meanwhile, the global push towards sovereign digital assets is just accelerating. India is actively rolling out its e-rupee through targeted welfare pilots.
Testing the waters with programmable money.
Exactly, testing it at scale. And this is moving in tandem with the broader BRICS coalition's plan to develop an alternative digital currency settlement system.
So when you synthesize all of this, the fear index, the ETF outflows, the massive geopolitical fiat expansion, the regulatory clarity, and traditional banking giants like Morgan Stanley building the plumbing, a very clear picture emerges.
A classic bear trap.
Exactly. We are seeing a classic supply absorption event.
The big guys are eating up the panic.
Yeah, the short-term holders and easily spooked retail participants are selling at a loss, reacting to the immediate macro news.
While the institutions just scoop it up.
Simultaneously, the smart money, corporate treasuries, and traditional finance institutions are quietly building the infrastructure to absorb that supply. They are treating Bitcoin purely as an institutional asset class.
Like a digital gold bar to be stored in a vault.
Yeah.
Exactly. A static asset.
But, and this is the massive pivot of this deep dive, while Wall Street is trying to wrap its arms around Bitcoin as this static asset class, the developers who actually live and breathe the Bitcoin network are building something that traditional finance hasn't even conceptualized yet.
They are completely blind to it.
Right. They aren't looking at Bitcoin as just a digital rock. They are looking at the underlying data as the foundational matter for a completely new reality.
The disconnect between how Wall Street views Bitcoin and how native developers view it has literally never been wider.
It's two different worlds.
Wall Street sees a ticker symbol. Developers see an immutable, physics-based environment that can host incredibly complex ecosystems.
To really understand this shift, we have to introduce the core framework of our discussion today. This research comes from Mo and Moestradamos research team.
They've been leading the charge on this.
They really have.
Yeah.
They are pointing to a monumental paradigm-shifting concept called digital matter theory. Digital matter theory, or DMT, requires us to completely unlearn basically everything we think we know about digital assets.
Okay, lay it out for us.
Let's look at the history of token creation. Up until now, if a developer wanted to create a new cryptocurrency, a token, or virtual land in a metaverse, the process was entirely subjective.
They just code it up.
Right.
Yeah.
They would sit down, write a smart contract, and arbitrarily decide the rules.
They just make it up.
Exactly. They might declare there will be 1 billion tokens in existence, or this virtual city will have exactly 100,000 plots of land.
Based on nothing but their own decision.
Exactly. The scarcity is artificial. It is dictated by a human being who could theoretically change their mind tomorrow.
Right.
DMT flips that entire model upside down.
It is essentially the difference between printing monopoly money and mining physical gold in the real world.
That's a great way to put it.
Because in Monopoly, Parker Brothers just decides how much colored paper goes in the box.
If they want more, they print more.
Right. If they run out, they just print more. But physical gold has inherent non-arbitrary scarcity dictated by the physics of the universe, by supernovas and planetary formation.
It's bound by physical laws.
Exactly. Under digital matter theory, we start treating the Bitcoin blockchain like a digital periodic table of elements.
We aren't inventing these assets.
Right. We aren't inventing these new tokens or virtual lands. We are discovering them. Digital archaeologists are looking at the raw, immutable data within the Bitcoin ledger and using it to generate non-arbitrary digital matter.
The philosophy here is profound. The time chain of Bitcoin, so the sequential, unalterable history of blocks dating all the way back to 2009, is treated as the ultimate objective source of truth.
The ultimate anchor.
Yes. It is an immovable object secured by massive amounts of physical energy. And the most prominent application of DMT right now, the foundational layer of this new reality, is an open source standard called Bitmap.
Let me clarify that pronunciation for you just once so we have it locked in as we move forward. Bitmap, as in bitmap, Bitcoin block mapping. I don't want to gloss over that because the name itself tells you exactly what it does.
Exactly. Bitmap transmutes the raw numerical block data of the Bitcoin network into a geospatial canvas.
It creates a map out of math.
Right. It maps the data landscape into spatial analogs. Every single block ever mined on the Bitcoin network is recognized as a unique district of digital real estate.
Here's where the mechanics of this get absolutely fascinating to me.
It's so cool.
Because if you buy a piece of digital land in a traditional metaverse, like, say, Decentraland or Sandbox, you just get a perfectly square, uniform plot of pixels.
A completely flat, boring square.
Right. The dimensions are completely arbitrary. But with Bitmap, the dimensions of the digital land are dictated by the actual data inside the specific Bitcoin block you are mapping.
The data shapes the terrain.
Yes. For example, a block mined in 2013 is going to look completely different from a block mined today. The total transaction volume inside the block might define the geographical area of the land.
So more transactions equals a wider parcel.
Exactly. And the V-bytes, the actual data weight or computational heaviness of those transactions, might define the depth, the topography, or the altitude of the terrain.
Because every single Bitcoin block in history has a unique transaction count, different fee structures, and different data sizes, every single piece of Bitmap land generated is completely unique.
No two blocks are identical.
Never. It is organically dictated by the economic activity of the network at that exact moment in time.
That is wild.
The land has a history. It is a topological shape defined by actual human financial behavior.
Okay, I can hear a listener asking right now, that sounds like a cool art project or a neat visualization tool, but why does the non-arbitrary nature of this land actually matter for investors or builders?
It matters because it fundamentally solves the governance risk that plagues basically every other digital ecosystem.
The human element.
Yes. In those older metaverse projects, you always carry the existential risk of a centralized foundation.
Right.
You buy your virtual real estate, you spend time building a business on it, and 2 years later, the CEO of the platform says, well, our user base has grown, we need more revenue, so we are going to arbitrarily mint 50,000 more plots of land right next to yours.
Instantly devaluing your property.
Instantly. The scarcity is destroyed, and the value of your property plummets.
It's the digital equivalent of a city council rezoning your quiet neighborhood to build a mega mall without your permission.
Precisely. It's devastating.
Yep.
But with Bitmap, that scenario is mathematically impossible.
Because there is no CEO.
Exactly. There is no CEO at Bitmap. There is no foundation that can just issue more land.
It's locked in.
The land is tied directly to the proof of work of the Bitcoin network. The only way new land is created is when a Bitcoin miner expends massive amounts of physical electricity to solve a cryptographic puzzle and mine a new block every 10 minutes. The scarcity of the digital real estate inherits the absolute thermodynamic permanence of Bitcoin itself.
That is a brilliant way to frame it. The scarcity is literally guaranteed by the physics of the network.
It's unbreakable.
So we have established the foundation. Bitmap provides the physical land, the unalterable geography of this new digital world, but land by itself doesn't create a civilization.
You can't just stare at dirt.
Right, you need commerce, you need a medium of exchange. What is the economy that runs on top of this land? How is value exchanged in a non-arbitrary DMT world?
This is where we move from the geography to the economic engine. Mo's research points to several economic models, but it outlines the role of a specific asset designed to act as the native currency of this ecosystem, known as NAT.
And that stands for non-arbitrary tokens, right?
Exactly. Non-arbitrary tokens.
Let's break down the mechanics of NAT because it follows the exact same philosophical rules as Bitmap.
It's born from the data.
Right. It isn't just a token printed out of thin air. It is sourced directly from a very specific piece of data within the Bitcoin block header called the bits field.
And that field is vital.
It is. Now, for those who might not be deep into mining architecture, the bits field isn't random code. It is a compacted hexadecimal representation of the network's hash target.
Basically, the difficulty adjustment.
Put simply, yes, it reflects the difficulty adjustment of the Bitcoin network.
The difficulty adjustment is honestly Satoshi Nakamoto's most elegant invention.
The thermostat of the network.
Exactly. As more industrial miners plug their machines into the network, the mathematical puzzles required to mine a block naturally get harder.
To ensure blocks are still only found roughly every 10 minutes.
Right. And as the math gets harder, the data within that bits field changes. Now tokens are generated based on the exact value of this bits field in every single block.
So the supply is tied directly to the energy spent.
Yes. The supply is algorithmically tied to the computational efforts securing the network.
And the reason this specific token is gaining so much structural importance right now is because it attempts to solve a very real existential threat to the Bitcoin network itself.
The security budget problem.
Exactly.
Well,
Let's talk about the second subsidy thesis.
the second subsidy thesis addresses a looming mathematical reality that people don't like to talk about. Bitcoin miners are currently rewarded in two ways.
The block subsidy and the fees.
Right. The block subsidy, which is the newly created Bitcoin they win for solving the block, and the transaction fees paid by users. But every 4 years, that block subsidy gets cut in half.
The halving.
Over the next few decades, that reward is going to halve again and again until it effectively approaches zero.
It runs out.
The original design assumes that as the network grows, transaction fees will naturally rise to replace the shrinking block subsidy, keeping miners profitable.
But what if they don't?
That's the billion-dollar question.
Right. What if layer 2 solutions like the Lightning Network become so incredibly efficient that base layer transaction fees just stay incredibly low?
The miners starve.
Exactly. If the fees don't cover the massive electricity costs of running these warehouse-sized ASIC farms, miners will simply shut down their machines.
And if they shut down, hash rate drops.
And if a significant portion of the hash rate goes offline, the network becomes vulnerable. A hostile nation-state could, theoretically, rent enough computational power to execute a 51% attack.
Rewriting the ledger and destroying trust in a $2 trillion asset.
It's a terrifying scenario.
It is. That is the vulnerability. A multi-trillion-dollar network protected by a shrinking security budget.
Right.
But under digital matter theory, we find a potential solution. Because NAT and bitmap are inherently tied to the block data, miners can claim or mine these DMT assets alongside the native Bitcoin at virtually zero additional energy cost.
It just comes with the block.
It acts as a companion asset.
Like mining for gold, but realizing the dirt you're moving is actually packed with silver and copper that you can sell as well.
That's a perfect analogy. This creates a second subsidy. It provides miners with a massive parallel revenue stream.
Without having to buy more machines.
Exactly. By giving miners an entirely new asset class to monetize, you incentivize them to keep their machines running, regardless of the Bitcoin block subsidy halving.
It functionally subsidizes the physical security of the Bitcoin network.
That's the thesis.
Okay, I have to play the skeptic here for a minute.
Go for it.
I see the elegance of the theory, but let's look at the actual market dynamics. You just said that miners are going to claim these NAT tokens alongside Bitcoin.
Yes.
These are massive industrial operations with giant electricity bills, massive payroll, and hardware costs.
They have overhead.
Huge overhead. If the supply of NAT increases with every single block that gets mined, and these miners are constantly receiving this token, their immediate fiduciary duty is to dump it on the open market to fund their physical operations.
To pay the electric bill.
Right. If you have constant, unrelenting sell pressure from industrial miners on an asset with an inflating supply, how does the value of NAT not just aggressively hyperinflate to absolute zero?
It is the most vital pushback to the theory, and the researchers address it directly by looking at the life cycle of money.
Great. How does it survive?
The valuation models suggest that NUP won't mature overnight. It goes through distinct phases of monetization.
It's like a startup.
Exactly. In the initial startup phase, NERD is essentially valued by its mint cost. If it costs a miner or a user $2 in base layer transaction fees to claim their NET, the secondary market might initially value it at a multiple of that cost.
So maybe they price it at $60 or $200.
Say 30 to 100 times the baseline fee, simply based on the speculative novelty and the friction of acquiring it.
Right, that's the early adopter premium. But that doesn't solve the long-term inflation problem when miners keep dumping.
It doesn't, which is why the ecosystem has to evolve into the market phase where the token develops deep utility.
People have to actually use it for something.
In this phase, NET isn't just a speculative token anymore. It becomes the universal unit of account for the entire DMT ecosystem.
The local currency.
Yes. If you want to deploy a smart contract on Bitmap or trade digital assets within this reality, you price it in NAT. The models compare this phase to the market capitalization of smaller Layer 1 protocols or even meme coins.
Reaching the multi-billion-dollar range.
Exactly, based purely on network effects and utility demand offsetting the miner sell pressure.
But the ultimate bull case, and the concept that really breaks my brain, is the quasi-dollar or M2 theory.
This is where it gets macroeconomic.
Yeah, this is where we bridge macroeconomic monetary theory with digital assets. Let's map this out clearly.
Okay.
In traditional finance, M2 is essentially the measure of the circulating money supply.
The everyday money.
The cash in our checking accounts, the money we actually use to buy groceries and pay rent.
Exactly. A functioning economy requires different types of money serving completely different purposes.
You need a store of value and you need a medium of exchange.
If we look at the physical world, humanity has mined roughly $13 trillion worth of gold throughout history.
A massive number.
Gold is our ultimate physical store of value. It sits in sovereign vaults.
But it's practically useless for buying things.
Right. Gold is heavy, it's difficult to transport, and you can't exactly easily shave off a tiny piece of a gold bar to buy a cup of coffee.
The barista would look at you funny.
Exactly. Therefore, we use fiat currency as our M2, our circulating medium of exchange.
Huh.
The global GDP is around $100 trillion, meaning the velocity and volume of our transactional currency far exceeds the base value of our gold reserves.
It circulates constantly.
Now, apply that architecture to Bitcoin and DMT.
Okay.
Bitcoin is pristine digital gold. It is incredibly secure, but transacting on the base layer is relatively slow and increasingly expensive.
It is designed to be a settlement layer.
A vault. If the digital civilization being built on Bitmap actually scales to millions of users interacting daily, they cannot use base layer Bitcoin for every microtransaction.
The fees would ruin them.
Right. NetAtt aims to become the M2 circulating money supply of this new world.
It becomes the GDP of the digital economy.
Yeah.
It handles the high velocity of money, so the daily trading, the gaming economies, the digital commerce, without ever trying to usurp Bitcoin's role as the ultimate store of value.
It is a totally symbiotic relationship.
Bitcoin is the gold in the vault, and NAT is the cash in the digital wallet.
But for any of this theoretical economy to function, we have to look under the hood at the engineering.
The actual plumbing.
And this is where the reality of Bitcoin's code creates massive friction. How does all of this heavy, complex, data-like virtual land, token economies, Turing-complete smart contracts actually function on Bitcoin?
Because it wasn't built for that.
No. Satoshi Nakamoto originally designed the network to do exactly one thing: send simple peer-to-peer payments in a decentralized way.
The scripting language is intentionally rigid.
Very rigid.
Yeah.
It is absolutely not designed to host 3D metaverses.
Right. Bitcoin is deliberately dumb at the base layer. That's why it's so secure. So what is the plumbing that allows these complex DMT assets to exist without breaking the network?
The solution lies in off-chain indexing and meta protocols. Since the Bitcoin base layer cannot natively read or execute the rules of these complex tokens, you need a system that can translate the data without compromising the security of the chain.
A translator.
This is primarily being handled by the Turing network and the TAP protocol.
Let's unpack the Turing network first. Imagine the Bitcoin blockchain is this massive, incredibly secure library, but all the books are written in a cipher that the librarian doesn't actually understand.
The node's the librarian.
Exactly. The librarian, the Bitcoin nodes, just ensures the books aren't stolen or altered. They don't care what the text says.
Right.
Turing acts as a decentralized indexer and oracle. It is essentially a network of specialized readers that constantly monitor the blockchain, decrypting the specific data patterns of bitmap and NAT.
And organizing a parallel ledger that makes sense of who owns what.
Exactly.
Cray establishes the consensus of state. It looks at the immutable Bitcoin data and agrees, yes, wallet A mined this specific NAT based on the bits field of block 800,000.
It verifies the reality.
And sitting directly on top of that indexer is the TAP protocol. TAP is the engine of programmability.
It's the smart contracts.
It allows developers to deploy Turing-complete smart contracts directly utilizing this index data.
Which is wild for Bitcoin.
We are talking about the kind of complex, multi-step, programmatic logic you would normally only find on highly flexible chains like Ethereum or Solana.
But it is anchored to pure Bitcoin data.
Exactly. Anchored to the most secure network on Earth.
And this technological stack leads to a massive breakthrough concept known as Bitcoin L1 co-processing.
This is huge for institutions.
I really want to emphasize how big of a deal this is for institutional security. Historically, if you held Bitcoin and wanted to participate in complex decentralized finance, say lending it out for yield or trading it on a decentralized exchange, you had to wrap it.
The dreaded wrapping process.
You essentially locked your real Bitcoin in a centralized vault or a smart contract and received an IOU token on a different network like Ethereum.
Which introduces catastrophic counterparty risk.
You're trusting the bridge.
and bridges break. We have seen billions of dollars lost because the bridges connecting these networks get hacked.
Yeah.
The vault is compromised, and the IOU tokens become literally worthless overnight.
Exactly. But with L1 co-processing, that risk is eliminated. Smart contracts operating on secondary networks can cryptographically read and manipulate assets directly on the Bitcoin base layer.
Without the user ever having to wrap, bridge, or give up custody of their actual Bitcoin.
Per custody.
You maintain the ironclad thermodynamic security of the main chain while utilizing the computational speed of a secondary network.
And we are already seeing this architecture in the wild right now.
Yeah, Taproot swap.
Taproot Swap recently launched as the first decentralized exchange built on this exact Bitcoin architecture. You can deposit into liquidity pools and trade assets entirely natively.
The programmability is just expanding exponentially. Let's look at BRC-420.
The recursive inscriptions.
Yes. This is a protocol built on top of this architecture that allows for recursive inscriptions. To understand why this matters, think about digital asset creation. In the early days of NFTs, a token was just a link to a static JPEG image.
A very expensive receipt for a picture of a monkey.
Exactly. But BRC-420 allows you to break digital assets down into modular, reusable components on the blockchain.
The best way to visualize recursive inscriptions is through a gaming analogy.
I love this analogy.
Imagine a complex video game being built on bitmap. First, a developer creates a 3D character model. They inscribe that code onto the blockchain.
That is one distinct asset.
Right. Then, another developer creates a highly detailed weapon. They inscribe that as a second asset. A third developer writes an AI behavioral script that dictates how a character moves and fights.
That's a third asset.
BRC-420 allows a user to recurse, or basically call upon those three separate pieces of code, and combine them into a single, cohesive, playable character.
And the economic genius of the protocol is that it tracks the provenance of every single component.
The money flows back.
If that combined character generates revenue or is traded, the protocol automatically routes royalty payments back to the original creators of the 3D model, the weapon, and the AI script.
It creates an open-source, composable economy where developers are financially incentivized to build complex tools that others can use.
But the reality is, processing all of those complex recursive calls and smart contract interactions requires immense computational power.
It's heavy data.
Very heavy. If you tried to process all of that directly on the Bitcoin base layer, the fees would be astronomical and the network would instantly grind to a halt.
The 10-minute block time is just too slow.
This is why the ecosystem absolutely relies on layer 2 solutions like Merlin Chain.
Merlin Chain is a critical piece of the infrastructure puzzle here. It operates as a ZK rollup layer 2 that is fundamentally tethered to Bitcoin.
ZK stands for Zero Knowledge Proofs. Let me explain how this works mathematically because it's brilliant.
Go for it.
Merlin acts as an off-chain computational highway. It takes thousands of these heavy, complex asset interactions, like the trading of NAT, the rendering of BRC-420 gaming assets, the smart contract executions.
All the busy work.
Right. And it processes them off the main Bitcoin network.
It does the heavy lifting in a much faster environment.
Yes, but the security guarantee is what actually matters here. After Merlin processes thousands of transactions, it uses advanced cryptography to roll them up into a single, tiny mathematical proof.
A summary.
A zero-knowledge proof. It basically says, we did all this math, and here is the undeniable cryptographic evidence that no one cheated and every single transaction is valid.
You don't have to check the work, the math proves it.
Exactly. Merlin then takes that tiny proof and settles it directly onto the Bitcoin main chain. The result: users get high-speed, low-cost transactions, but the finality and security of those transactions are guaranteed by the permanent ledger of Bitcoin.
It is brilliant engineering. The plumbing is literally being laid down brick by brick to support a massive digital civilization.
It's being built right now.
But here is the paradox. While these Bitcoin developers are heads down, painstakingly building this highly secure, permanent, non-arbitrary architecture, the broader cryptocurrency market is violently shifting its attention in the exact opposite direction.
The market is incredibly impatient.
We are seeing a massive flight of capital and user attention toward artificial intelligence and high-speed, low-cost chains.
The market narrative is fiercely competitive. Let's look at a prime example of this shifting tide.
Magic Eden.
Yes, Magic Eden has historically been a dominant cross-chain NFT marketplace. They facilitated massive volumes on Bitcoin and Ethereum EVM networks.
They were everywhere.
But they just made a startling announcement. By early April 2026, they are completely winding down their Bitcoin and Ethereum marketplaces.
Winding them down completely.
They are shutting down their operations on the two largest blockchains in the world to focus their resources exclusively on Solana.
That is a staggering departure.
Yeah.
To literally walk away from the liquidity of Bitcoin and Ethereum is a massive bet.
A huge pivot.
And I think it perfectly illustrates a deep, structural, philosophical divide currently splitting the entire digital asset industry in half.
It is the ultimate trade-off between performance and permanence.
Those are the two sides.
On one side of the divide, you have platforms like Magic Eden and the users migrating to Solana. Their priority is pure throughput and user experience.
I want it to feel like Web 2.
Right. They want transactions that cost fractions of a penny and settle in 400 milliseconds. They want the network to feel exactly like a traditional server, smooth and instantaneous.
No friction.
They are willing to accept the arbitrary nature of tokenomics and the potential governance risks of a highly centralized validator set if it means the system runs incredibly fast.
But on the other side of the divide, you have the DMT ecosystem building on Bitcoin.
Oh, purists.
Their philosophy is that true, sovereign digital ownership requires the unalterable security of proof of work.
It has to be immovable.
They are betting that if you are going to build a permanent digital reality, the foundation has to be immovable, even if it means enduring the agonizing process of building complex layer 2 plumbing like TRC and Merlin just to make it functional.
It's the difference between building a tent that goes up in 5 minutes versus pouring a concrete foundation that takes months to set.
And right now, the market is heavily rewarding the high-speed, futuristic narratives, specifically anything intersecting with artificial intelligence.
AI is just sucking all the oxygen out of the room.
Look at the data from the AI sector this week. The explosion is tangible. Bitenzero, which is the decentralized AI network utilizing the TAO token, just saw its asset surge 46% month to date.
Pushing the price right toward the $300 mark.
And the catalyst for that TAO surge wasn't just hype, it was a major technical milestone.
Real deployment.
The network successfully deployed the Covenant 72B model on their subnet 3. For context, Covenant 72B is a massive 72 billion parameter large language model.
That is heavy-duty computing.
It is. That is a highly sophisticated AI capable of complex reasoning and generative tasks. What makes this revolutionary is that it was trained and deployed entirely on a decentralized network.
No corporate servers.
It definitively proves that massive AI computation can happen on a distributed protocol without relying on the centralized corporate servers of companies like OpenAI or Google.
This is where the threads of our deep dive finally weave together. We have to look at where these two massive trends, the surge in decentralized AI and the development of non-arbitrary digital matter theory, inevitably intersect.
This is the sci-fi stuff.
It really is. The research points toward a concept known as AI swarms.
This is where the conversation moves from engineering to genuine science fiction, except it is actively being built. Let's map out the concept of an AI swarm.
Walk us through it.
You have these decentralized AI models running continuously on networks like Bitenzero. As these agents become increasingly autonomous, executing tasks, trading data, and interacting with users, they're going to need two things: a place to exist within the digital landscape, and a native currency to transact with.
Exactly. Traditional financial rails require a human identity, a passport, and a bank account.
KYC.
Right. An autonomous AI agent cannot walk in and open a Chase checking account.
Obviously not.
But in a decentralized DMT environment, it doesn't need to. Under digital matter theory, an autonomous AI agent could literally own its own digital matter.
It can own property.
It could purchase a piece of bitmap land to host its visual interface, its data storage, or its virtual storefront. And it could pay for its own computing resources, its server time, using NAT that it earned directly through its on-chain actions.
So let's just play this out to its logical conclusion. What does this all actually mean for the structure of society?
It gets deep very fast.
Think deeply about the implications of those AI swarms. If autonomous, decentralized AI agents start aggressively accumulating NAT as their native borderless currency, and they begin buying up prime bitmap real estate to host their own operations, expanding their digital footprint.
They could become the biggest landlords.
Exactly. Will we eventually see a digital economy where human beings are literally renting virtual space or buying data from an AI landlord?
It completely flips the dynamic.
It completely redefines what the concept of ownership means when the richest entity in the digital civilization doesn't even have a heartbeat.
If you want to continue the conversation and stay updated on Bitcoin price action and developments across the Bitcoin DMT ecosystem, check out the Discord link in the description or on the channel, where Mo will be sharing ongoing research, insights, and updates. We'll see you next time on Inside Bitcoin.